Well, good day, and thanks for joining me today. David Scott, one of the market analysts here at City Index, and also covering off Forex.com across the Asia Pacific. Of course, you're here because we saw that inflation report out of the US overnight, really soft in June. 0.06 for core month on month, which was way below the 0.2% expected. And the headline rate, of course, is actually negative at minus 0.06 month on month. So again, a really weak outcome. And one that not only was good news for the Fed, and it explains what the moves we've seen in rates markets recently, but really soft in the context of what's going on in the US economy as well. So I'm not surprised to see there's a little bit of concern out there as to what actually the message might be when it comes to some parts of the US economy, because it was just really cold. And we know that when it comes to other things like data surprises in the United States, when we look at the Atlanta Fed GDP Now forecast model, all of those have been rolling over recently. So interesting, you're going to see the market reaction. When it comes to what I'm trusting, first and foremost, with all the movement we've seen over the past 12 hours or so, it's the rates market signal that I'm taking most thought out of here, because lots of moving parts. We know in the FX market, there's likely been BOJ intervention on behalf of the Ministry of Finance. So lots of things to go and try and digest. And the really strange reaction that we saw in US equity markets. Yes, there's a bit of rotation underway as well, but I wonder whether it might be the start of something more meaningful. We'll look at that on the charts as well. Look, we might as well go and kick off and have a quick look and see what the signal from the rates market has been. And it's been pretty definitive at that. We know that the markets have moved really aggressively and are now actually fully priced for a cut to come through 25 basis points from the Fed in September. Having a quick look at here, this is the Fed funds futures curve you can see in front of you. And right now, it's got about 50 basis points differential between the June contract and the December 2024 contract at this point in time. That translates across to about 2.5 cuts being favored now by the market when it comes to what the Fed will go and do this year. Really different to what we saw only a couple of months ago. You can see here at the start of June, there was only around about just over one cut being priced. So we're seeing a pretty aggressive move, and you can see here over the past 24 hours or so, that big leg lower, that indicates what we saw after the inflation report. So the market rushed to go and add the prospect of easing coming through. Now, a few people have been talking about the potential for a move in July. I even flagged it last night that if the Fed really wanted to, the grounds are there to go and do it. You can see what's going on in inflation. The disinflationary trend is very much intact at this point in time and undershooting pretty aggressively now relative to expectations. And we know that the unemployment rate has been rising as well, up to 4.1% in the United States. Not anything alarming by any stretch of the imagination, but it has been trending higher. And if you exclude the impact of the public holiday, the Independence Day holiday in the United States, which probably went and changed that initial jobless claim print last night and resulting in a big decline coming through, it's pretty obvious that the US labor market is also softening at this point in time. We know that the Fed has been talking about two-sided risks, so making sure that it's not just focusing on the inflation battle now, but also the activity side of the equation. It's dual mandate of the labor market in particular. And we also know that Jerome Powell has been looking for good news on inflation. He's got that, yes. And we also know that the labor market is now no longer an impediment to the Fed moving. But for them to go in July just comes across as a little bit rushed. I think what they'll say is they'll go and start softening the market up. The speakers that we'll go and see over the next week or so will likely go down that path, and then maybe they'll formalize a proper easing bias in the July statement, basically signaling to the market that unless there's some kind of really rogue inflation data or a sign of re-strengthening in economic activity, they're likely to go and cut in September. Now, the transfer across to what we're seeing for what's the expectations for rate movements this year. This is also the Fed funds curve, but this looks between what we've been seeing in June 2024 and June 2025. And right now, you can see around about 5 cuts are being priced into the market. That doesn't look unreasonable for my expectation. We know that the Fed already thinks that policy is very restrictive at this point in time, even if it delivered 5 cuts. If its expectations are right, and I'm not saying that is, if the expectations are right, then it would still be in mildly restrictive territory, the Fed funds rate. So at this point in time, that looks about right. I can't really see a big adjustment coming through. The only way you will see the market add to cuts beyond what we've already seen is if we really see economic activity start to roll over. Next week, retail sales comes out in the States, a few other reports as well. So keep a close eye on those real activity indicators, because they will be very key when it comes to the Fed moving forward. Look, no surprising when it comes to some of the moves you've seen in rates markets. Treasuries, you can see here, 2-year yields off the lows a little bit today, but again, very much back to levels not seen since the earlier parts of this year. You can see here, twos got down to around about 4.5% and bounced overnight. Tens as well, also well and truly have fallen to levels not seen since the middle of March. You can see here the impact when that means on curves. So the 2s, 10s curve, which has been an excellent predictor of recessions in the past. Maybe not so on this occasion, we'll find out soon. But you can see here, we've seen a steepening take place. So again, this is over a longer time frame. You can see here there's been a steepening. So what we're seeing is the front end of the curve, yields have gone and moved lower faster than at the back end of the curve. And if we see the Fed continue to go and move towards easing, we're expecting to see that disinvert and actually go positive for the first time in nearly a couple of years. So that's something to keep an eye on as well. Unless the 2-year yield drops really quickly, it should be pretty good when it comes to those cyclical asset classes as well. I know, particularly when you talk about financials, borrowing short, lending long, that's the kind of bread and butter that they love at this point in time. Look, that's the message from the rates market. So all at the moment, easing is pretty much guaranteed over the next couple of months, probably 2 cuts at this point, maybe 3, depending on what the incoming data says to the Fed when it comes to that real activity. So what does that mean when it comes to other asset classes? Well, I thought we'd go and have a quick look at what's going on with the DXY at this point in time. Let me go and get up the right chart here for a second. And you can see rate differentials have gone and played a pretty big impact on what we've seen here. Now, DXY 106.13 double top, and it's been pretty ugly ever since. A bit of a rebound that came through. That was probably likely a bit of pre-positioning ahead of this inflation report. It had fallen a little bit beforehand. But you can see here, just the technical signals that we'd seen. Big bar. And look where it bounced, 104. It's done a lot of that work over the course of recent times. So the fact that it bounced there is not really that surprising. It also, when it closed back above that 200-day moving average, which to me is still a pretty important signal at this point. Now, this big downside wick we're seeing on the candle, a lot of that has to go and do with what's been going on in dollar yen. We know that the Bank of Japan has likely intervened in the market overnight, and we saw dollar yen really tumble on the back of that, but it's rebounded back up, and that's helped to go and strengthen the US dollar against not just the yen, but a basket of currencies. So I'm not surprised to go and see that. At this point in time though, the US is losing that economic exceptionalism tag, and it's losing it pretty quickly at this point in time. Now, unless we get a scenario where economic activity globally really starts to go and roll over, it's hard to go and see the US dollar being really in big demand in that circumstance. It might actually be the case for the first time in a long time, the dollar is now a sell on rallies prospect rather than a buy on dips. But for the moment, the price signal we're seeing here, including the pin bar that's coming through, hasn't completed, obviously, this daily bar. But that is telling you again that there's demand to go and buy the US dollar index whenever it's dipping below that 200-day moving average. On the downside, 104 is the key level to keep a close eye on as well. We might go and get to the stocks, US markets in particular, and we can't go past what happened in the Nasdaq overnight. Really big reversal, and a lot of people are kind of scratching their heads. We'll get to the technical side of it in a second. The one thing that I think a lot of people are also missing as well is that lower inflation is going to go and basically create headwinds when it comes to top line revenues. Inflation, essentially higher prices, is something that can go and juice revenues. Now, if you start to go and see inflation come back, that doesn't really mean that there's going to see a subsequent pickup in demand automatically in some of these names that have rallied really hard on the AI side of the equation. The mega cap tech names have obviously benefited from that particular area. But what we saw last night was a big reversal coming through in those names. Now, is it really going to go and juice AI spending as well across the broader parts of the economy? Look, maybe at the margin it will, but I don't think it's going to go and really change the already really high bar that's been put into markets. Will it go and improve the prospect of rate cuts coming through and lower inflation? Will it go and boost demand in other areas of the economy? arguably more so. So it's not unusual to go and see that with a bit of rotation coming through. The Russell 2000 really benefited. That got a big gain last night, got a lot of attention as well. And the Nasdaq was clearly on the nose. Is it going to go last though over a longer period of time? Well, I'm debatable at this point in time. Look, it could be the start of a big reversal last night, but until the actual price action obliges and tells me that there's follow through selling, right now it's not. And you can see here overnight, Nasdaq futures, first trend line that it came up against, uptrend. You can see here, stopped and bouncing. Right now, it's fiddling around. It's not actually going through, but it also stopped dead at that former high back in late June, around about 20,371. So at the moment, it's just standing here. It's not really doing anything. If it manages to go and pop back above that trend line, who knows? We could be back up here and talking about the record highs in the not too distant future. At the same time, if it was to go and say pop down below 20,371, who's to say it won't go and move back below 20,000? You can see the next level of support that I've got here is 19,730. And there's also a gap on the charts when it comes to the Nasdaq futures that may be looked to fill by traders. So potentially could even get down to around about 19,608. I'm waiting for the price action right now to go and tell me, yes, it was really unusual on one day. Does that mean it's going to be a part of a lasting trend? Well, lower interest rates are also going to help to go and boost the value of those really lofty future expected earnings as well. So we'll see what happens when it comes to earnings season as well. It will be a lot about guidance, but it's too early to go and test the really bullish mindset that's been priced in by markets as to what it will mean when it comes to top line and bottom line growth. So come down to guidance, unless there's some really clear evidence that the AI hype is not justified at this point in time, it's hard to get too bearish at this point. E-minis, SPOOs, pretty much the same story as again, reversal, not a big one, and reversal after hitting record highs overnight. And no real sign that we've seen follow through selling the call today. And look, just solid uptrends. Solid uptrends had to fall down through back to the 50-day moving average there. But again, is it telling me anything that's super alarming at this point in time? The answer is no. At this point in time, it looks like it may have been a one-off. I'll wait to go and see what happens over the next few sessions to see whether it's part of a longer lasting trend. If it is a longer lasting trend, there's no point trying to go and preempt it right now. Wait to go and get the signal at this point in time. I'm not getting it from this chart at all. Those who are trading, you can see the record high 5707.50 is one level to watch. On the downside, 5588 is the first level I'll be paying attention to. Much like Nasdaq futures as well, 5454.50 could be a target if we do start to go and see a little bit more downside materialize. There is a small gap in futures that is found there. The Dow is one interesting market. It's not anywhere near as cyclical as the Russell 2000, but it's one of those ones that I'm paying pretty close attention to because much like some of those other indices we've seen around the world recently, it has shown signs that it wants to go and break out of the pattern, the triangle pattern it's been stuck in over the course of recent months. You can see just the price in Dow futures here just been coiling up over the course of time since back in March. And the fact that we're seeing a failure here, another failure here, then look, it hasn't been definitive break at this point in time, but it has managed to go and break that downtrend. And just given the price action that we've seen recently, lots of demand coming through at 39,400 in recent weeks in particular. And that break, there's every likelihood that we might go and see a pushback up towards that record high at 40,358. Just given convention, if we go and see this go and extend and actually a proper breakout and that high taken out, there's every chance we'll be talking about Dow futures moving into maybe 41,000, 42,000 territory. Keep a close eye on those round numbers. We know that when markets are setting fresh highs, they tend to go and gravitate towards those round numbers on occasion. Since we're in Australia, I'll have a quick look at the ASX 200 SPY futures. Now, not everyone agrees with me, but I think a lot of what we're seeing recently is the seeds were sown a couple of sessions ago. You can see, much like the Dow, we had a bullish breakout from this calling pattern, the triangle. And then again, big breakout, stalled at resistance at 7886. But then after the inflation print, and then today, just boom, up we've gone, and we've taken out the highs that were set back in May this year. We're now around about, 23 odd points away from record highs. I'll be very surprised if we didn't get a chance to go and have a look at that at some point, to at least go and test the level, see whether we can break above it. If we can't, Who knows? Maybe it's a good short at this point in time. Just remembering though that unless economic activity really rolls over, rate cuts from the Fed, regardless of what the RBA does, is likely to be really beneficial when it comes to those cyclical names, particularly the Aussie market, which is dominated by banks and miners in particular. Gold, precious metals is one area as well that I know a lot of people have got questions about at the moment. And much like we'd seen in some of those other markets as well, really big, nice move overnight. See, in a minor stop trend at this point in time, and it took out this very minor resistance level at 2409, I should say, at this point in time. And it's just sitting on that level right now. But notice, given the trends at the moment, not only when it comes to price, but also in momentum indicators, MACD, RSI as well, to me, the path of least resistance for gold right now, knowing that the US dollar is likely to be less stronger than what it's been recently, and the fact that real yields and nominal yields are likely to be far lower than what they were in the past, unless we've completely gone and disbanded those old drivers of the gold price, it's really difficult to see gold getting too much downside from here. I think it's more likely to go up than down at this point in time. And then when you think about some of the fiscal equation around the world, not just in the United States, but in Europe and other parts of the world, when you think about how much money is being printed out there at the moment, again, it's difficult to get too bearish on gold in this environment. It managed to go and hold up and hit record highs with interest rates at record highs and a really strong dollar. What happens when those two things reverse? Well, I don't think that unlikely that we'll see the gold price go and pull back by any meaningful margin. I thought I was going to end off looking at some of the other moves in the currency markets. I think I'm going to look at the dollar yen first. I talked about it a little bit earlier on. But yeah, getting a lot of attention. First question, did the BOJ intervene on behalf of the Ministry of Finance? Well, of course, we don't know for sure, but the coy answers we're getting from a lot of the Japanese officials today tells me that there probably was at least a rate check, if not intervention, that took place over the course of last night. Big volumes going through as well. I don't think it can really be just explained by really short positioning, lopsided positioning, record short positioning amongst speculators at this point in time. It looked like it was given a nudge per se, but if you go and zoom in and you look at what's going on the daily chart, it's pretty obvious what we're seeing. Just taking one of my bars away. Here we go. You can see the price bounced clearly. 50-day moving average, which has bounced off multiple times in the recent past. False break here, back through it again. And also an uptrend that's been dated back to the beginning of the year. So that level there is really important. I'm not surprised to go and see this big bounce back today. Not only we saw a retest on Thursday, but another one today. And the fact that it hasn't managed to go through, even with the threat of intervention, I don't think it's going to really dissuade the market too much. The MOF might get a bit trigger happy again if it maybe sees the pair push back above 160.23, which was acting as support for a period of time. That might go and get their eye and might go and see them go and move again. We'll see what happens with the PPI report out later on tonight in the United States in particular, which could go and give clues as to what we'll see with the Fed's preferred inflation measure, the PCE core deflator, later on in the month. But for now, no, until the dollar yen breaks this really key level, it's very difficult to get bearish on it. Buying dips is the much easier process than selling rallies at this point in time, unless we see a big move up really quickly where there's no follow through when it comes to rate differentials and that. Just really quickly on that as well, I'll just touch on, for a long period of time, dollar yen has been really driven by what goes on with interest rate differentials, but that's really watered down. There's been no real strong correlation whatsoever recently. Super quick, basically these lines here you can see at the top are yield spreads between Japanese and US 2, 5 and 10-year debt. And you can see here that overnight, US, the spread between the 10-year tenors actually fell to levels not seen since May of 2023. So quite a big pullback from the levels that we're seeing. So the benefit that the dollar yen used to go and get from really wide and growing yield differentials looks to have reversed now, which makes me cautious on chasing it too hard at this point in time. When it comes to the BOJ side of the equation, it really is a rounding error in the broader scheme of things. It comes down to what the Fed is going to go and do with interest rates. I think it's going to be more important if and when rate differentials start to become more important yet again. Quickly, Aussie US. Yeah, a lot of people are scratching their head about this. I wrote about it in a yarn earlier today. look, it still managed to go and finish the session higher, but a big, pin, bearish pin coming through, which a lot of people might go and look at and go, well, that could be a topping pattern or something like that. But realistically, Aussie's looking all right at the moment. Yes, China's not really humming along at this point in time, but Fed rate cuts, maybe an improvement in the global economy. That should be the kind of environment that should support Aussie US. Overnight, there was a really, really decent correlation coming through on a shorter time frame between Aussie and E-minis, SPOs, US futures overnight, which to me really reflects what's going on in mega cap tech names. I can't go and buy into the idea that the Aussie should be driven by what's going on in the Mag 7 names. It just makes no sense to me. You're talking about, it didn't follow them higher to record highs, obviously. So why should it start following them when they start to go and give back territory? That's why, to me, Aussie against some of the crosses, in particular the European crosses, it looks all right at this point in time. So I don't mind buying those at this point in time. On the downside, you can see the price bounced around about 67.30 earlier this week. That is the first level of support to look at. Again, 67 has been also an area that was capped prior to this breakout. And look, above the high, 68 essentially it was last night, would be the area where resistance is located at this point in time. If we see that go, I think markets will start to go and look back and say, okay, well, where's the next target up here on the upside? Potentially, the high that we saw back late last year, or the double top around about 68.93 that was seen back in June and July of last year. On the last bit, Euro. You can see here, much similar price action to what we saw on the Aussie, but not quite the scale of the reversal in place. Look, it looks decent. We might go and get a golden cross as well with the 200-day, 50-day moving average about to go and cross over the 200 at this point. But it's hard to get really super excited about the Euro at this point in time. I don't think it's going to really go off to the races against the greenback, and it might go and lag some of those more cyclical names that have underperformed relative to it in recent times. On the downside, 108.55 is the first downside level to watch. Then you've got this confluence at 108 is a pretty important support level. It's done a lot of work there, and you both have the 50 and the 200-day moving average there as well. On the top side, 109.16 was where the high was last night, and above that, you're talking about 109.81 and 110 will be the levels to go and keep a close eye on. We'll see what happens, of course, with that PPI out in the States tonight. I expect it's going to give a pretty similar story to what we saw in the CPI report out overnight. In terms of what it's going to go and mean to markets moving forward, we'll keep a really close eye on Fed commentary from here. I expect we're going to see a clear shift. I think they've seen a lot of evidence now coming through on the inflation front, and there's pretty clear evidence as well that their dual mandate is also starting to come under a little bit of threat should they continue to go and run pretty aggressive tightening monetary policy. Anyway, we'll see what happens. Thanks so much for joining us today. Enjoy the rest of your Friday, and I'll catch you next time.